Welcome, friends. Today's topic is about tax planning or capital structure of the company. You can call it as the capital structure or financing structure. There are two different terms. So we'll be learning what is capital structure and what is financing structure. We'll be seeing how tax planning is relevant. Every company, when it does business, it needs some money. That money that is needed, we call it as capital. Capital is the money which is used in business, isn't it? And most of you must be knowing that capital can be brought in two forms. Either you can bring capital through equity, that means owner share, or it can be brought through debt. Yes or no? You can bring equity or through debt. Yes or no? Are you agreeing with me?
Yes,
Yes,
sir.
sir.
These are the two sources. And we use that money which is brought either through debt or through equity or through a mixture. That means mixture of debt and equity. So we collect that money through debt and equity and use it in the business. Why you use in the business? Because we expect business will give us some return. Okay, business is going to give us some return. And when you get the return, when you expect that return will be the same. So we're investing money keeping in mind that return will be accruing to us. But thing is that when you bring money, it has also got a cost. Is it? It has got a cost. So this cost is called as our cost of capital, right? Those who have studied financial management will be able to appreciate it in a better manner. That is called as cost of capital. Suppose cost of capital is, let us say, 12%. So we'll expect the return should be more than that. Return should be more than 12%. Then only we'll be able to create wealth, we'll be able to add value to the business. So always our earning or return should be more than the cost of capital. And these costs has got again two components briefly. If we talk about, one is cost of debt and cost of equity. And even in the most of businesses, when you do business, we use the mixture. That means mixture of sources. We use some debt and some equity. So we calculate what is the cost of debt, what is the cost of equity, and what is the overall cost. And we'll try to do business in such a way that we gain more return than the cost of capital, than the overall cost of capital. And when we're computing this cost of capital, since this is an important, very important element of business, cost of capital, their tax plays a very important. So in any business, tax plays very important role. Right. Basically, if you look at the business, indirect tax definitely plays an important role because whatever you purchase, whatever you sell, indirect tax is already included in that. It is already embedded in the system. It affects your cash flow. That is one part. But today, what we are going to discuss about impact of direct tax on our capital structure. Okay, let us first understand what is that capital structure and then how it affects our or how income tax affects the capital structure. And because of tax, how cost of capital is reduced or cost of capital is affected. That's also we are going to know. But first, let us quickly recapitulate what we have understood regarding this corporate taxation. After that, we'll be quickly seeing what is the capital structure, how that can be managed. So for friends, we already know, we know what is tax planning. Okay, tax planning already, when you talk about the tax planning, that means we are thinking about some legal means so that we'll be able to minimize our tax burden or we'll be able to postpone our tax liability. So with these two objects, that is the objective of minimization of tax liability or postponement of tax liability, we do tax planning. And here today's plan is to learn some tax planning so that we can structure our capital in such a way that ultimately earning can be maximized. Okay. What is tax avoidance evasion? You already know, we had discussed it in our earlier classes. For tax planning, now just to recapitulate it, that it is some legal methods we are going to adopt, which will be useful in long run. Okay. And companies tax rates also, so some cases 25%, 30%. These are the normal tax rates which are applicable to a domestic company. We have also studied the rate applicable to foreign company varies from 40% to 50%. right? That also we know foreign companies rates are different. Okay, and surcharges applicable at different rates. A domestic company 7% and 12% rate of surcharge, for foreign company 2% and 7% is the rate of surcharge which is applicable. All these things, tax rates we had discussed earlier, and a separate recorded video is available for you. You can refer to that. And some specific situation, company has got option to choose different tax rates, like it may be 22%, it may be 15%. Okay, otherwise normally tax rate is 30% and maybe 25%. Okay, but one more thing which we have also studied earlier, that when you are computing tax for a company, companies are subject to provisions of minimum alternate tax, or what we call it as the MAT. MAT is applicable to the company. What is MAT? We have already discussed in detail, but today again I will be recapitulating those provisions. In that case, what will happen? When you're computing, when you're thinking of the MAT, then we need to first of all know what is the book profit of the company. How book profit is to be computed? If you visit to Income Tax Department website, there is a tutorial on MAT. In that MAT, how book profit is computed, step-by-step process are explained. You can refer to that. But for right now, for our understanding, we'll take book profit is just like our accounting profit. How much profit we have shown in the books of accounts. For our understanding only, we'll be taking it as book profit. But actually, that profit needs to be adjusted to arrive at the book profit. Now, once book profit we know, then we'll be able to compute MAT. What we'll do? First, compute total income. Okay. Are you able to see it now? First step is compute total income. Then compute tax as per normal provisions of Income Tax Act. So you compute total income, compute tax as per normal provisions. This is step 2. Third step is that compute book profit. Have you remembered how to compute book profit? Or should I show you again? Third step is the compute book profit. Then compute 15% of the book profit. So here you see there is a tax on step 4. There is a tax on step 2 also. Step 2 is the normal profit, and step 4 is what? 15% of book profit. Okay, tax. Step 2 is the normal tax, and step 4 is the 15% of the book profit, which we call it is the minimum alternate tax. Then how much you will pay? Step 2 or step 4, whichever is higher. Okay, understood?
Yes, sir.
Whichever is higher, you have to pay. Once you have decided that is the amount you have to pay, then what you will do? You will add health and education cess 4%. If surcharge is applicable, surcharge will be added, and health and education cess will be added. It is not SHSC, it is health and education cess. Health and education cess 4% will be added. Okay, and you have to pay the higher. And in case you are paying under MAT, that means in case step 4 is higher than step 2, that means actually you are paying extra. Okay, let us say normal tax liability is 100, but you are paying 120. That means you are paying 20 rupees extra. That 20 rupees extra can be carried forward as MAT credit for 15 years. Okay.
Yes,
understood? Okay, understood. So this is the provision of MAT. So I just wanted you to recapitulate this thing so that we know this company's taxation happens like this. Various rates are there, tax rates are there. We will be able to compute tax by applying those tax rates, maybe 25%, maybe 30%. And some special situation, it might be 15%, it might be 22%. But that is one thing. But by applying all these things, we'll be able to calculate the tax. Okay. And we know the moment it is a company, MAT provisions are also applicable. So we have to check that what is the MAT liability. If MAT liability is more than your normal tax, you have to pay MAT. And the extra money you are depositing can be carried forward for 15 years, right, as MAT credit. Okay. Right. Is it clear up to this?
yes, sir.
Now, if it is clear, now we'll try to understand what is the capital structure. Right. Capital structure in financial management we'll be learning in detail. But here we'll be very briefly understanding this thing. When we See, what is capital structure? What we are referring to? The combination of the capital in the business. Combination of the capital means what is the composition of debt and equity in the business is referred to as the capital structure. Okay. So when you say capital structure, it doesn't mean equity alone. It means debts also, and all other forms of borrowings are also included. Okay. In fact, it talks about how an entity, how an organization, or how a company finances itself, how it is arranging finance. That is its capital structure. Okay. Broadly, this capital structure can have two broad components. One is debt, other one is equity. Okay. And every company tries to minimize the cost of capital. Once you know capital structure, we know this is the composition of the capital, then every company tries to minimize the cost. If cost is minimized, owner's return can be maximized. Okay. Therefore, capital structure planning is important. And our capital structure should be efficient. Okay. We should have an efficient capital structure. Okay, you see, this is the meaning of capital structure as defined by Van Horn says it's a mix of fast, permanent, long-term financing represented by debt, preferred stock, and common stock equity. That means combination of debt, the equity, preference share, and debt like debentures, etc. Entire combination can refer to as the firm's capital structure. Okay, and to think about the planning of the capital structure, whether we should have more debt, whether we have less debt, we need to learn certain theories in fact. So they are called as the capital structure theories. That is a different part. That is totally a financial management paper. Certain theories are there which says that you should have more debt. Certain theories are having you should have less debt. Okay, like this. So they are pure. They are in the pure area of financial management. We are not learning that thing. We are only now we'll try to understand one type of classification of the capital structure so that we can only think that how it is related to tax. Okay, from that angle only we will say. So that means while deciding the capital structure, we should also should keep in the mind the implication of income tax. Okay, so just to understand this implication of income tax, we'll be classifying this capital structure into like this. One is something we'll call it as the horizontal structure. Horizontal structure means this company has no debt. There is a possibility that a company may have no debt. You can call it as a zero debt company. You can say capital structure is horizontal. You can find out only equity shares are there. Okay. Or capital structure can be vertical. Vertical means you see there is a small portion of equity shares, little more preference shares, and debt. Equity is less, debt is more. If this is the kind of capital structure, then it is called as vertical capital structure. Okay, equity part is small. And this kind of capital structure is vulnerable to hostile takeover. If someone acquires the small equity, their entire business will be his business. It's a possibility of takeover because equity size is small, one can acquire it. Understood what is vertical capital structure, what is horizontal capital structure?
Sir?
Yes,
please. Is this capital structures are for new businesses or it is for overall company?
No, this is for all. This is for all. Thing is that when you start a new business, the capital structure is more important. Okay. Initially, when you start the business, you decide the capital structure. Once capital structure is decided, after that, adjusting capital structure is a difficult task. For old businesses, it is very difficult to adjust the capital structure. Why it is difficult? But let us say you started a business and you have taken a wrong combination of debt equity. Actually, you should have taken more equity, but you have taken more debt. Something like this. Or you have taken, let us say, less equity, you should have more equity. So at the beginning, we need to be very careful what is the right kind of capital structure we should have. Okay. If you take wrong, then what will happen? If debt is there, no issue, you can reduce the debt. If debt is more, you can reduce the debt. If you are having cash flow, you can pay back. But can you reduce equity? Reducing equity is difficult. Okay, reducing equity means you are planning to buy back shares. I'm not saying it is impossible, but you have to buy back shares. That's a difficult process. Therefore, capital structure ideally needs to be decided at the beginning when you are starting the business. Okay, but later on also, if you want, you can revise your capital structure.
Okay, sir.
Okay,
Understood.
but it is extremely
Yes.
important at the beginning stage for any new business.
Sir, like this horizontal and vertical structures, where these are used, any examples like we can fit this into the market or corporate,
You
like in
have to,
MNC?
I will tell you, you have to look at the company's balance sheet. If you do not find any zero, you do not find any debt, then you can say capital structure is horizontal. If you find equity is less, I will be showing you some example after some time. Equity is less, preference share is more, debt is more, you can say this is horizontal, vertical. Or some or other types of capital structures are there. In fact, there are 4 types of capital structure, which I'll be showing you one by one. Okay.
Okay, sir. Okay.
Now, next type of capital structure is pyramid shape. Pyramid shape, as you can look here, equity is more. Then above that, little less is retained earning, that is reserve. Equity share, let us say 15 lakh. Retained earnings, let us say 10 lakh. And debt is 5 lakh. If you look at their balance sheet, if this is the situation, then you can say this is a pyramid structure. It's a very stable structure. Okay, very firm structure. Nobody can easily disturb this kind of business because its capital structure is equity is more. Okay.
Sir, preference capital and capital, how is it different?
Yeah, preference share capital means, you see, share capital can be broadly of 2 types. One is equity share capital, where all the equity shareholders equal. They will be paid dividend depending upon the profit. Profit earned will be distributed to them. When I say preference share capital, it is a share capital where the holders of preference share capital has got preferential right. Preferential right as regards to receipt of dividend and as regards to receipt of money in the event of winding up of the company. So when the company is winding up, we'll be giving the preference. First, they will be paid. After that, if money is left, then equity shareholders will be getting. Same also when we are distributing dividend. First, preference shareholders will be given. They have got preferential right. After that, only if money is left out, that will be received by equity shareholders. That is the difference. And equity shareholders are really the true owners because they share the profit, they share the losses. And the preference shareholder, what happens, that dividend is fixed. Suppose it is 9% preference share means they will be getting 9% only. Even if profit is much more, but since it's 9% preference share, they will get 9%. Suppose it is 12% preference share, they will be receiving 12%. Okay, but equity shareholders, it depends. If more profit, they will get more. If less profit, they will get less. Did you understand?
Okay, sir. So, yes, sir. So preference capital is same as this preference shares we have.
Yeah, that's what we're talking about.
Okay.
Preference shares.
Okay, got it, sir.
Correct. Yeah. And there is one more capital structure, which is reverse capital structure. You can see as it looks like. So little equity, little more retained earning, and much more debt. So this type of capital structure is vulnerable to collapse. Okay, so this is not a good capital structure at all. So these are the various kinds of capital structures we see. Right. Now you have seen it is important for any entity to plan the capital structure so that the business can be far, business can be stable. Okay, now friends, why it is significant that we'll see later on. Now at this stage, in fact, also we need to distinguish between capital structure and financial structure. This theory, what is capital structure, what is financial structure, you can read later on. You can recorded videos will be available. You can pause the video and read the entire slide. But today I'll be only explaining you this thing with the help of this is a balance sheet of a company. You can see, right? So you see there are assets, there are current assets, non-current assets, and current assets. These are the total assets. You can find the equity and liabilities. Okay, you can find out this much is equity, this much is the liability. Current liabilities are also there. If you see this particular portion, this portion means equity and non-current liabilities. It's long-term liabilities, all the long-term equity and long-term liabilities, we call it as the capital structure. This part is the capital structure. But if we include short-term liability also, that is current liabilities also, if you include, then this part will be called as financial structure. Okay. This is capital structure and this is financial structure. And this entire structure tells us that these are the source of fund. Company collects money from these sources, and the same money is used here on the top part where assets are there. That means this is the application, this is the source. Okay, source is our capital or financial. This is the capital structure, this is the financial structure. So when structuring this thing, while designing this thing, we have to keep in mind tax planning aspects also. Okay. Are you getting it?
Yes, sir.
Okay, friends. Now, understood what is capital structure, what is financial structure. You have also understood. What are the factors that influence capital structure? These are, in fact, financial management area. I just wanted to give you some brief idea about capital structure and financial structure so that you'll be able to appreciate its importance and should be able to appreciate how tax has got impact on that. Now, you see, capital structure, friends, we know capital structure, we need to have a good capital structure so that we can collect money and that money can be used at the business. And it is also, as a manager, responsibility is that to ensure that money is collected at a less cost, meaning the cost of capital needs to be low. That is basic things, right? And you have seen when capital consists of broadly two things, meaning either equity or preference. So equity has got a cost and either equity or debt. So equity has got a cost or debt has also got a cost. So we need to know what is the cost of equity and what is the cost of debt and what is the overall cost, right? And this rate of tax affects that cost. Okay, here before knowing that, first of all, we need to understand that when we talk about equity's cost, when you are, let us say, issuing equity, so what is expected? So we pay dividends to them. So cost to company is, in fact, the dividend that is going to be paid to equity shareholders. Or you can say, if we give certain dividends to them, what is dividends are what that is expected by equity shareholders, is it not? Equity shareholders expect dividend, and what is their expectation? That is cost to the company. So dividend that is going to be paid is the cost to the company so far as equity shareholders are concerned. But so far as debt holders are concerned, company's cost is not dividend. What we pay them? Interest. Is it not? Debt holders, do we pay dividend? We pay interest to them. Yes or no?
Yes, sir.
So debt holders collect interest, equity holders collect. Now, problem here is that interest is an expenditure because interest is paid to outsiders. This is an expenditure for the company. When it is an expenditure, when I pay interest, what will happen? My profit will be reduced to that extent. Yes or no?
Yes, sir, but it is also a cost to company. Expenditure.
Interest is a cost to company. Interest is a cost to company. But let us say I'm paying interest. To that extent, interest is an expenditure. To that extent, my profit will be less. Let us say, for example, let's say before interest, my profit is 100. Okay, before paying interest, my profit is 100. I am paying interest of 20 rupees. So after interest, what is the profit?
Sir, 80.
80. Now you will be paying tax on what? 80 rupees or 100 rupees. That means interest will be reduced or interest will not be reduced. What do you feel?
Sir, after interest tax.
After interest. So you will be paying tax on 80 rupees. Let us say here is a company, tax rate is 25%. So how much interest will, how much tax will you pay? 25% of 80, how much? 25% of it. How much?
20.
20 rupees tax you are going to pay. Okay. Understood? 20 rupees tax you are going to pay because your profit before interest and taxes is how much? 100. Interest is 20. So profit before tax is 80. Tax at the rate of 25% is 20. So, but that is profit after tax is 60. Good, got it?
Yes, sir.
Okay, it is fine. This is what, why you are paying interest? Because you might have collected debt. Why you are paying 20 rupees interest? Let us say you might have a debt in the capital structure, which is 200. On that, you are paying 10% interest. If there is a debt in the capital structure, you are paying 20. Understood now?
Yes, sir.
Now you see, tax is this. Now let us say your capital structure is such a that there is no debt. Debt is not there. If debt is not there, then where from you arrange this money? You have arranged this money through equity. But when you are arranging through equity, whether equity shareholders will be paid interest? Answer is no. Equity shareholders will be paid what? Dividend. Are you getting?
Yes, sir. Dividend, which
Equity
is
shareholders will be paying dividend. Understood? Equity shareholders are paying dividend means dividends are paid to the owners. They're the owners. That is the owner's reward. That is not an expenditure to the owners are rewarded by dividend. So dividend is not an expenditure. So let us say same 20 rupees we are paying to dividend as dividend. Since interest is not there, so PBIT is 100. Okay, here your profit after tax was 60, right? Now you see. Let us say now interest will become 0. You are not paying anything. Okay, PBT is becoming 100. Yes or no? Interest is not paid. Dividend is paid.
Sir.
But dividend is not an expenditure. Dividend is not allowed as a deduction. Tax on 100, how much you will pay? 25. Instead of 20, you are paying 25.
Yes, sir. 100.
Okay. And what is profit after tax? $75.
Yes, sir.
Okay. Now you can pay dividend. Dividend, let us say you are paying now 20 rupees. So how much will be retained in the company? $55.
Yes, sir.
Okay. Are you getting how we are retaining in the company? Now let us say this equity is also 200. On that equity, we are paying dividend how much? On 200, 20. What is the percentage of dividend?
10%.
If I am asking you what is the cost of equity, you will be saying 10%. Because to avail the equity of 200 rupees, you are paying 20 rupees. Cost of equity is how much? 10% or not?
10%.
Now, what is the debt? Earlier, what was the debt?
200.
How much interest you have paid?
20.
How much is the rate? What is the cost of capital? What is the cost of debt capital? On 200, you are paying 20. What is the cost?
10%.
Same 10%. So you are saying it is actually 10% here. 10% is here. Cost of debt is 10. Cost of equity is also 10%. Is it not?
Yes, sir.
But you see, when you paid interest, look at the tax. In the tax, instead of paying 25, you are paying 20. So, because of interest payment, there is a saving. There is a tax saving of 5. Is it not? There's a tax saving of 5 rupees. So even if you are
Yes.
paying 20 rupees, you are saving 5 rupees. Effectively, your cost is not 20, 15. Because one hand you are paying 20, other hand you are saving 5. Your cost is 15. So effective cost you can say, or you can say after tax cost of debt is not, is not 10, it is 15. Okay, 15 on 200 means 7.5%. Understood now? So by paying interest, you are able to
No, sir. So the
the
last part you could repeat.
you see, you are paying 15 rupees. Your actually interest cost is 20, but saving is 5. Effective cost is 15.
15, sir.
1.5. Yes, no.
Okay.
20 rupees you are paying, but tax you are saving 5 rupees. 15 rupees and 200 rupees. That means percentage wise it is 7.5% is the cost of it. Understood?
Yes, sir.
Now, if you keep tax into consideration, you find even if outside it appears debt cost and equity cost is same, when it took tax into consideration, it is felt that debt is cheaper. Debt is cheaper. Debt is 7.5% and equity is 10%. Okay. Just think about this for a moment. We'll take a break right now. Again, we'll catch up immediately. Okay, maybe in 10 minutes we are going to catch up. Just think about this issue.